As we start with question 4, we'll come back later to that. So you are told that define the term free cash flow. So that one, our next method. I'd also explain how the free cash flow can be, that one will come to it. Then number B, we have discussed two advantages and two disadvantages of economic value added. We say that one of the advantages of economic value added, this method is easier to compute and hence to explain to the managers. Another advantages, remember we said that either is good or it's consistent with the objective of maximizing shareholders' wealth, as well as EVA uses cash flows, not the profits. One of the disadvantages, remember, is that EVA can be complex, mostly when the number of the transactions are too huge. So now let's go to part C. That's our target. Part C. And the following information related to Joshua Limited. Statement of profit or loss is extracted extract for the year we're given there. For both the year 2013 and 2014, that's the income statement. Also, you are given the statement of financial position extract for the year. We have both 2013 and 2014. Now let's go to the additional information. Number one, Joshua Limited had an uncapitalized lease valued shillings 10 million in each for year 2013 and 2014. 2013 and 2014. So an uncapitalized lease. You see, in this case, they never capitalized. So that one will add back to the value of the capital. Then number two, the capital employed as per the year 2012, financial statement was 223. Then number three, the pre-tax cost of the debt was estimated to be 9% in year 2013. And 10% in year 2014. Also, you are told that Joshua Limited, that's number 4, Limited cost of equity was estimated to be 15% in year 2013 and 17% in year 2014. Number 5, the pre-tax accounting profit is obtained after deducting economic depreciation. Now, economic depreciation is more of what we call capital allowances of the company and current asset. This is also the depreciation used for tax purposes. So that means the normal depreciation as a provision, and also you're given the economic depreciation. We have said that economic depreciation is more of capital allowances, which is an allowable expense. But for normal depreciation, that one is a disallowable expense. It's just a provision. Then you are told that number 6, the target capital structure of the Joshua Limited is 60% equity and 40% debt. So those are the weights. And now the effective tax rate is 30% in both the year 2013 and 2014. Economic depreciation was 30 in the year 2013 and 35 million in year 2014. Then other non-cash expenses were 10 million per year in both 2013 and 2014. Now for the non-cash expenses, you need to add back them to the net operating profit after tax. Then you are told that interest expense was 4 million in the year 2013 and shillings 6 million in the year 2014 required. Stating any assumption made, estimate the economic value added. How do we get EVA? Number one, we have said that to get the economic value added is the difference between the no part, that's the net operating profit of tax, and the return on capital employed. So in this case, we have 2 years. We have, or before that, first of all, let's get the cost of capital. For you to get the return of the capital employed, you need to be having the cost of capital. We have said that cost of capital in this case, you use WACC. And how do we get WACC? It's the weight of equity, cost of equity, weight of the debt, cost of the debt, 1 minus the tax. So now let's get the weight. Let's get the weight. So we have WACC. We get WACC for 2013 and also WACC for 2014. So now how do we get the weight? Now let's go to additional information, note number 6. Additional information number 6. to be 15%. Number 4. Joshua Limited cost of equity was estimated to be 15% in year 2013 and 17% in year 2014. So the cost of equity for 2013, that one we are told it was 15%, and for year 2014, it was 17%. And then you add weight of equity, cost of weight of the debt, cost of the debt. Now let's go back to note number 6. Note number 6. We are told that the capital structure of Joshua Limited is 60% equity and 40% debt. Now the weight of the debt is 0.4, 0.4. You multiply by the cost of the debt. Let's go to note number 3. Note number 3. The pre-tax cost of the debt was estimated to be 9% in year 2013 and 10% in year 2014. So this was 9%, this was 10%, and then you deduct the tax. We are told that the tax rate was 30%. So 1 minus T, so that one becomes 0.7, 0.7. And in that case, how much do you get? So in this case, you'll get 11.52%, and the other one you'll get 13%. Any question up to that point? Any question? Ask a question in case you have a question up to this point. In case you have a question, raise your hand. So now let's continue then. So now let's determine the EVA. In this case, we have year 2013, 2014. So we have said that to get the EVA, you take the no part. So you take profit after tax, profit after tax, profit after tax. For 2013, it was 44. This one was 45. That was the profit after tax. Then let's go back to note number 10. Note number 10. Note number 10. Interest expense was 4 million in year 2013 and 6 million in 2014. You see, the interest expense is not an operating expense. So that means you add back because you are getting the net operating profit after tax. So you add the interest. And in this case, it was 4. And the other one was, it was 6. Let's go to note number 9. Note number 9. Other non-cash expenses were 10 million per year in both 2013 and 2014. The non-cash expenses, so that means they were not operating. So that means you add back the non-cash. And you are told that there were 10 million per year. So it's 10, you get 10. So that means you are no part. So this one, 44, that's 54. That one you get 58. Also for 2014, how much do you get? How much do you get? What do you get for 2014? Sorry? No, you're adding back. You're adding back. 5 plus 16. That is 61. So this one you get 61. No, but in this case, the interest should be the net of tax. Remember, tax is an allowable. Remember, interest is an allowable expense. So that means for year 2013, the interest expense was 4 times 0.7 should be net of tax. So how much do you get? 4. Are you getting 2.8? 2.8. Also for 2014, it was 6. So it's 6. It should be net of tax times 0.7. Yeah, it's 4.2. So that means our no part will change. So that means our net operating profit after tax, this one will be 58. 56.8. And this one will be? 59.2. So that's the no part. Then we deduct the return on capital employed. How do we get the capital employed? So for the capital employed, in this case, you need to be very keen. For year 2013, you have to use the capital employed for 2013. Now, remember the closing capital for 2012 becomes the opening for 2013. And the working capital for 2013 becomes the opening for 2014. So in that case, let's go back to additional information. Note number 2. Note number 2. Note number 2. The capital employed as per the year 2012 financial statement was 223. So for 2013, I repeat again, you use the capital employed for 2012 because the closing working capital, the capital employed for 2012 becomes the opening for 2013. So in this case, you have 223, and then the capital for 2013 becomes the capital employed at the beginning of 2014. How much was it? Let's go back to the financial statement. The statement of financial position, to the statement of financial position. For 2013, can you see 250? That's either the total assets or the finance by, that's the capital. It was 250. So the capital for 2013 becomes the opening for 2014. Now let's go back to additional information number 1. Additional information number 1. Number 1, you were told that Joshua Limited had non-capitalized lease of 10 million in each year for 2012 and 2013. We have non-capitalized lease. So that means you have to capitalize it. So that means you add the lease. And the lease was 10. This one was 10. So now that means the adjusted capital employed is 233, and this one is 260. Now let's get the EVA for 2013 and 2014. So in this case, we have said that you take the no part. So the no part for 2013, it's 56.8, and for 2014, it's 59.2. And then you deduct the return on capital employed. We already have the capital employed. For 2013 is 233 times, you already have the cost of capital. That's the WACC. For 2013, the cost of capital was 11.52. So this one you will multiply by 11.52%. For 2014, the capital employed was 260. If you want to get the returns, the cost of capital in this case was 13%. So that means for 2013, you get 29.96, and also for 2014, you get that 5.4. So now this is how you can comment. Based on the using EVA for 2013 and 2014, since the two figures are positive, so now we can see that the economic performance or the wealth of the company, that one is good. Because this is 29, that means it's positive. Also that 5 is 0.4. But to be specific, we can see that 2014, they are doing greater than 2013. And I think we have also answered even part 2 of the question. Part 2, comment on the performance of Joshua Limited. Now we can see that Joshua Limited is performing well because its economic value added, both here, they are positive. But you can also emphasize that 2014, they are doing great because they are having higher than 29. So any question now?